Everybody, Brett Swarts here, Capital Gains Tax Solutions, Dan Palmer and Susan Trulio, and today we're talking about one of the biggest objections that we see with the Deferred Sales Trust, which is trust, right? And trust is a big piece of what we do. It's literally the name of our title, trustee. And the biggest thing we find is that a lot of people want to know that they have enough controls in place to mitigate any risk or mitigate any scenario with the DST. What's the worst case scenario? And so that's today's topic. What's the worst case scenario with the DST and how is risk managed? Dan, you were speaking with a gentleman, I think even just yesterday, right? Owned a bunch of commercial real estate in California. What was the big objection when he just started to learn about it for the first time?
Yeah, he just wanted to keep control of the funds, which you can't do if you want the deferral. So that's your opportunity. You can keep control of your funds, you pay your tax, and then you control the rest. But if you want the deferral, there has to be a third-party unrelated trustee. That's what our company does. That's why we were in the conversation. And he just didn't feel comfortable with relinquishing any controls, had all the worst-case scenarios of what possibly might happen, or how somebody could invest his funds without his knowledge, or steal it and ride off into some beach on the other side of the world, and just couldn't get over the idea of trust, even though he was in a 1031 exchange where he had already trusted those funds to a 1031 intermediary. So trying to explain to him, you already do this, you just also have to do it in this situation.
Yep, and so let's help people overcome that, right? And by the way, just to clarify, you don't have unilateral control over the trust, because unilateral control, by definition, equals ownership. And if you sold your asset to a trust which you own unilaterally, that is by definition constructive receipt. Just like if you sold it to your sibling, you sold it to a business partner, you sold it to someone that's connected, related to you in a way where you have too much control, that's considered constructive receipt. That's taxable, right? And you're right, Dan, they often have already done it. And I think sometimes it's an emotional reaction, right? Because they have done it for so often with either like escrows, they sent money, Susan Trulio is 25 plus years as senior escrow officer, done 1,000 plus transactions. They just send the funds there and they don't even say anything. They're just like, the funds just go there, the $1 million down payment or whatever it is, and it's there. Or they use a 1031 exchange and it's just there and they just take it for granted, but they are trusting to a third party the funds, or their financial advisor, right, that they use, right? Or call it Charles Schwab or whatever it is. And so these are third-party groups at different levels, institutional, Charles Schwab, and then you have 1031 exchange companies that can be larger or smaller. You have title companies that are governed by different laws, regulations, different things. So there's different levels of controls, but they're giving up control is a big piece of it for a period of time. The second thing I would say is pooling funds versus single entity. In fact, we've heard horror stories of groups that have gone with 1031 companies, especially during the downturn of 08, 09, where you're going into a pool of funds, like your exchange dollars go into this big pool, and it's commingled with all of the other 1031 funds, and that's like red flag, danger, 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 right? And there's been circumstances where you can look this up, where these companies have gone under, they were floating the money, they're doing something, and it's a disaster, and people lose all of their money and still owe the tax, really bad stuff. Our scenario is single entity trusts that are never commingled, right? And are never in any of the trust. Our company's a Capital Gains Tax Solutions trustee company. It's not our trust company. Their single entity trusts have their own EIN, their own statements, their own Charles Schwab account, and nothing moves without the approval of the note holder. And so sometimes just that simple piece right there can help people understand, oh, okay, got it. It's not in this pool, and there's controls in place, and I have transparency. But you're right, Dan, like you do have to give up some control. Otherwise, you owned it, right? Now, what do you own, Dan? What technically do you own in the Deferred Sales Trust? You own the what?
You own the promissory note. So the trust owes you all the proceeds plus a rate of return. And so instead of receiving all the funds up front and paying tax immediately, you're going to be paid over time. And you're going to pay tax on what you receive when you receive it. But in the meantime, it's compounding and growing in your favor within the trust, and depending on what state you live in, it could be upwards of 40% more proceeds compounding and growing in your favor. And so it's a huge win. But in order to have those extra proceeds working in your favor, you have to have a trust and you have to have a trustee.
Yep. Let's see how we did. So Susan, let's play that back. See how we did, right? Which one? The deferred sales trust, is it a pool of funds or is it a single entity?
It's a single entity.
Yep. And what does that do? That helps to create protections, correct?
Absolutely.
During escrow, Susan, did you guys have single entities where the funds would go to? Were they individual escrow bank accounts, or how did that work? If there was 100 transactions going on, and when you were in the Bay Area of California, Sacramento, doing these transactions, how did that work? Like, let's say there's 50 million of down payments. Was it sitting in Orange Coast Title's one bank account, or are they separate escrow accounts? I'm kind of curious on that.
Yeah, it's a separate escrow account. Each escrow is specific to that transaction. Just like a deferred sale trust, the funds are not commingled. That way everyone's funds are safeguarded.
Yep, perfect. So that's the key thing to understand. If you've done transactions as a real estate developer, as an owner, as an investor, and you have sent funds to escrows, there's single escrow accounts. The deferred sales trust, similar, is not commingled. Now, if you've done 1031 exchanges, you want to be really careful, because there's those that do pool and there's those that do single accounts. They're not commingle. So keep an eye out for that. Okay, so the next thing, let's just talk about risk, right? So sometimes people think about risk like, is there people that are not trustworthy with the funds, right? So that's the first thing, you got to figure that out. Well, let's talk about those people. Do we have accountability, Dan? Like how many eyes or different individual groups at any kind of given time can either hold each other accountable, actually see the things that are reporting? Can you kind of break down a couple of those groups, Dan?
Yeah, I think you have the note holder who actually, sold their property or sold their highly appreciated asset, and they received a promissory note in return for being paid up front. And so, of course, their eyes are on it. It's their money, and they want to be paid. So they're looking at all the portals. They're checking the investments. They're kind of walking through it with you. You also have the tax attorney. So the tax attorney doesn't work for us. We don't work for him. So you have the tax attorney who formed the trust, whose eyes are on it. You got a third-party tax preparer. Every year, the trust prepares a tax return, and so they're going to be looking at all the numbers and the investments and the returns. Then you also got each investment opportunity, and so wherever they're invested, even if it was just a brokerage account with Schwab, they're going to have 24/7 view access, and Schwab's handling that money. And so there's actually a lot of different eyes on the funds. It's not, like everything's happening in our house and we're doing everything ourselves and nobody else gets to see anything. There's a lot of checks and balances because so many people have a part of the process.
Excellent answer. And I'll just kind of add to that a little bit and add a couple other ones as well, right? So yeah, you have the note holder. They have 24/7 view access to the investments, especially at Schwab. We also work with groups like Raymond James and different independent RIAs and such. We have stuff at Morgan Stanley. I mean, so these are large, biggest financial institutions in the world. Yeah, you have the tax attorney. Now we work with the tax attorney, not for them. So a little adjustment there, but that's important. Like they don't work for us either. So we can also hold them accountable, right?
Isn't that what I said?
I
I think we don't work for them and they don't work for us.
I may have missed that, but either way, we work independently of one another, and that way we can even, it's a good thing, right? Like we're not in their office and they're not in our office. It's just another third-party group. That's important because if we start doing something that's not consistent with ethically or integrity or with the process, they are independent from us, and the clients obviously can contact the attorneys and say, hey, something's going on here, right? So that's really important. Now there's third-party tax preparer. They're doing a full profit and loss statement, right? That's really important. These really more function like a C Corp, okay? And so that's another level of reporting that's important, okay? Also, all the K-1s, all the 1099s, you're right, Dan, they're looking at all the numbers, so spot on there. We have, you already said Schwab. Schwab is the biggest financial institution in the world, so 24/7 access to view the funds online if the funds are at Schwab. But there's also a third-party, typically financial advisor, okay? And that's important, right? Because that's another set of eyes that are looking and showing and recommending investments. And then, of course, we're the third-party trustee, right? So that's like 6 groups, right? It's like 6 groups, and so each are independent, each are third party, and each have their eyes. The more eyes and the more ears and the more focus you have on anything, right? The more likely you are to catch either errors or challenges or things that are it could be going haywire. So I just want to kind of let you know that. I think the next part of the risk aspect of this to talk about would just be maybe the legality of the tax. Right now, it's close to 30 years now, thousands of transactions, over 30 no change audits. So never had a change in any of the audits. It's batting 1,000 legally. But someone might say, well, but what if I'm the first one where it doesn't work because my CPA says, or my tax person says, or someone I read such and such. Matter if I'm that person that doesn't work. Well, number one, what's the worst part of that? What are you risking, right? So generally, it's about a 10% penalty plus you owe the tax plus interest, okay? So let's just say you had $1 million worth of tax liability, right? That you were supposed to pay 2 years ago, right? And so and don't hold me to this exact equation. This is just, we work with your CPA. We could talk with the tax attorney to really break this down, but I'm just going to give you a general framework. Let's imagine you were in Taxifornia or New York, and you had like a 37%, you had a zero basis, and so you owed about, $1 million of tax liability there, right? And you would have paid that, but you hadn't paid it in 2 years, and they've called the Deferred Sales Trust, it doesn't work, or you did it improperly, you owe the tax, so you would owe the $1 million back. That's number one. You'd owe probably a 10% penalty, so that's $100,000, okay? And then you would owe interest on what you should have paid, and I'm not quite sure what the interest rate might be on that. Let's use a 10% interest as well, just to be safe. So on $1 million, you're looking at somewhere around 100,000 divided by for 2 years. So it's let's just say $200,000. Again, I'm not sure of the interest rate on what the IRS would charge on that. I know the penalty is like 10%. Now again, this has never happened, okay? But let's just say, okay, so that's $200,000. That's $200,000 that you would owe in about basically 2 years. I actually think the interest probably maybe around like 5%, but I'd like to actually get that number. But let's just use the higher amount, okay? So had we already earned interest on that, you can see that the time value of money, right, could offset that. So what would we have to earn in order to offset that, right? Well, we'd have to earn at least $100,000 plus the interest. So we'd have to earn somewhere around, I think about 20%, right? 20% over 2 years, which is about 10% per year, especially if it's compounding, okay? So that's another way to think about it. Like, what is my worst case scenario? Now, you would have already paid the $1 million. Now let's imagine we'll use a $3 million total proceeds to defer about $1 million. So on $3 million, we have to earn about $200,000. Well, 10% of 10% on $3 million is $300,000 per year. Okay, because they're going to do it on the taxes owed. They're not doing it on the net proceeds, right? It's the taxes owed. So you earn $300,000 in year one. You earn $300,000 in year two. If you owed $200,000, so you'd have $600,000 minus 200, you're actually $400,000 ahead. So Dan, are you seeing that math, or what did I miss?
Yeah, so you got really deep in the weeds there for our listeners, but I think just to summarize, number one, it's never happened before. So what we're talking about here is if you were, for some reason, the first person that we ever worked with that failed an audit, you'd have these fees attached to it. Second point is, if it was after 2 years, you would have out-earned the penalty and the fees.
Yep, exactly. And then obviously you could say, well, maybe I earn 8, maybe I earn 12, maybe I earn 7, whatever it is. But if you only earn 10, right, net of fees, you're looking at that. Now, you would have also paid the legal fee. We have to keep this apples to apples here. So let's say on a $3 million sales price, you're looking at $15,000 on the first million, and on 2 million, 1.25%. So that's another $25,000. So technically, you could say the difference isn't 400. The difference is 375. And let's just say the trustee fees on average were 2%, just to put it at the high. So that's 60 times 2. So that's 120. So 375 minus 120 would give us the number. So you would still be ahead mathematically $255,000, okay? After the penalties, after the interest, assuming interest was 10%, assuming the penalties was 10. Okay, so that's just giving you the risk that's never happened, like Dan said before. What other risk, Susan, might you think about that someone could say that, you know, or that you might think of right now? Yeah, that's a great one, right? So just the timing of all of these things, just like the timing risk of the 1031 exchange. So I would say your biggest risk of not having a DST and going just for a 1031 is running out of time. And so therefore the deferred sales trust mitigates that risk because it actually cuts down the pressure for you to buy that property. But you're right, the other part of it is if you don't qualify for a 1031 and you're not using our best 1031 exit plan, it's the risk of running out of time to set this up. Right now, we want to take that risk off the table. Now, Dan, how do we do that with our conditional engagement agreements, and how does that work?
We just make sure that they have the proper option language before all contingencies are removed. So they have the option to utilize. It doesn't force them to use the deferred sales trust, but it gives them the option to, should they choose to. And then you don't have a 11th hour renegotiation where everything kind of blows up. The language is already there before contingencies are removed. You get to the time of closing, and now for the seller, that option's on the table. It gives you the freedom to choose the direction that you want to go.
Nailed it. So we call this the 100% conditional engagement agreement, meaning like for any reason at any time you don't want to use our services in the trust, you owe us zero, right? And like Dan said, the trust language is an option that's inside of the contract, which mitigates the risk, what Susie says, was running out of time to use our strategy. And so, yeah, we want to let you know about that. That includes working with the tax attorneys, forming the trust, doing the planning, you know, talking with your CPA, educating everybody, literally like doing 95% of the work, right? And if you don't want to use it for any reason, you don't owe us anything, you can just say, no, I decided to pay my tax, which we say with tongue in cheek, there's almost about 40 trillion of US debt, and some good Americans need to pay it down. So now hopefully it's not you who's listening to this, right? We want you to, you know, be able to defer that, compound that, make great decisions with the wealth. I think the last one that I'll just touch on, and we got to jump here as our time is running out, is the potential, someone might say, well, you know, what if the investments fails and the funds are lost? Could I lose my entire nest egg? So number one, in our strategy for the way you structure it with an installment sale, if you put it all into Apple stock and all Apple goes to zero, right? And first of all, we diversify. We wouldn't put it into a single stock. You know, those are some things, but let's hypothetically, right? You put it all into Bitcoin, put it all into Apple stock, put it all into one real estate deal, and that deal fails and you get zero. Well, if you never receive anything back from the trust, you owe zero. Now that's different than a 1031, right? A 1031 that this is interesting, right? From my understanding, those 1031s that have failed, or those companies have failed, and they basically stole the money or lost the money in some kind of pool of stuff, people still owe the tax, which is like the worst thing you can even imagine. In our scenario, the investments were made, the investments are lost. You don't owe the tax because you never receive back anything. The trust essentially goes bankrupt, right? Because the trust has nothing to pay. That's why it's a single entity as well. So that's something to understand. Second thing about the risk part of that is you should de-risk because you have an extra 20, 30, 40, 50%. Therefore, you can take less risky investments because you can earn let's say a lower interest rate to be able to, ideally pay you what you want to be paid from the trust. So it should just naturally help you to de-risk because of that bigger pool of money to work with. We're way over time. I want to thank everyone for watching this. You can go to capitalgainstaxsolutions.com to get started to build your capital gains tax exit plan, to meet with myself, with Dan, Susan, to dive into this, to see if this could be a great fit for you. We promise to never talk to you anything if it's not a good fit. Any point you don't think it's a good fit, you let us know. We just want to give you an opportunity to see and understand and experience what the opportunity is to defer capital gains tax using our services here at Capital Gains Tax Solutions. Just go to capitalgainstaxsolutions.com. You can also check out the book, Building a Capital Gains Tax Exit Plan, with Kevin Harrington from Shark Tank. But we appreciate everyone listening and watching out there. He's Dan Palmer. I'm Brett Swarts. And that was Susan Trulio. We appreciate everyone. We'll talk to you soon. Bye now.